Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, July 17th, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend. Taking a look at the trend gauge over here, you can see the four arrows, four green pointing higher arrows that have been here for multiple weeks now. Market leaders definitely acting well and had a great day today. And all five of the major indexes trending above their short-term 21-day moving average, medium-term 50-day moving average, long-term 200-day moving average. This is just a simple way of identifying a healthy market versus a risky market. When we're trending above moving averages, the market is very much in a bullish posture, and we take advantage of that by getting into the best stocks in the best sectors, as well as ETFs representing those sectors and the broad market. So what happened today? Not a lot of news, but mild gap down overnight, but close to green by the open, and just a plain old bullish session where we just trended higher, making higher highs and higher lows until a mild pullback the last 30 minutes, but new recovery highs for the S&P and the Nasdaq 100, also for the Dow, and growth leaders continue to lead the way. This is why we instituted the RG8 over about 2 years ago now. After growth stocks peaked in the first quarter of 2021, we needed a way to make sure that we could recognize when the indexes were and big caps were what was leading us higher. There are actually three stealth bear markets in small caps, starting with late Q1 2021, late 2021, early 2022, and that was before the bear market really even kicked into high gear. But this RG8 really doing its job for us, gives us the confidence to stick with small and mid cap leaders when they identify themselves. We always want to make sure we've got the wind at our back. Anyway, it led the way up 1.4% today. S&P 500 up 0.4%, Nasdaq 100 0.9%, Dow up 0.2, mid caps up 0.6, Russell 2000, the leader of the five indexes, up 1.05%, led by banks today. Global diversified 60/40 stock and bond up 0.19%, muted returns today for bonds, emerging markets, and developed nation international stocks. In-house GROTECTION, great combination of leaders in the SSO, led us to a 0.7% approximate gain today. We'll hit the tail of the tape in charts of interest. We're also going to talk about how we're going to risk manage our Tesla position into earnings, which are after the market close this Wednesday. Let's dive right into it. We'll start with the chart of the S&P 500, and as I said, new recovery closing highs. Not a whole lot to be said about this. It's bullish. We're extended 5.3% from the 50-day moving average. That's a little bit to the upside, but it's in a bull market, so the bull is not ignoring how stretched it seems to be from historical norms. Let's take a look at the NASDAQ 100. Again, new recovery highs, 8.6% from the 50-day moving average since breaking out last week. Tacking on successful sessions to that, mixed in with a constructive pullback on Friday when we got just a bit too extended. But just like that, by the end of the day today, we're right back to where those highs were on Friday. Dow Jones Industrial Average, new recovery highs, going back to December anyway. 6 days up in a row, still relative weakness, but trying to break out above this 34,600 level convincingly. Mid caps taking a little bit of a break on a relative basis over the last week or so. You can see this is really just a nice little bull flag being put in here. Since its big bounce off the 21-day moving average on July 6th. And finally, small caps, new highs also as I said, led by the small cap banks today. And a lot of banks going to be reporting their earnings this week. Will be big banks and regionals will be interested in uh, keeping an eye on the reaction there. Let's go to the dollar. Dollar started off strong today, closed near the lows of the day. Let's look at a 5-minute chart here, and you can see a little bit of a gap up and then just trickling lower, just the complete opposite of the market as it trickled its way higher. The VIX up slightly today, uh, but at the bottom of the range. So it not really in sync with the market today. You can see the big gap up on the VIX, and then it just started trickling lower, trickling lower. Again, not really in sync with what's going on with the market today. Let's go to precious metals. We'll start off with silver. Silver down, but at the high of the range. GLD just barely making a gain. What gold bulls are looking for here is this declining 50-day moving average acting as resistance. They want it to transform from this bull flag into a breakout above that 50-day moving average. Gold stocks just barely positive today, bounced off this declining 50-day moving average. Also, let's flip to bonds. BND, broad bond market, tight range today, up fractionally. Bond prices up means bond yields down slightly. Here's the TLT, also up mildly, tight range today. Let's go to the yield on the 30-year, basically flat today, and the yield on the 10-year. Down 0.6 today. Bitcoin taking a break. Big rally last week in Bitcoin on Thursday, pulled back Friday, pulling back again into this 50-day moving average. So breakout from this handle or this tight consolidation within the handle has failed for now. And in fact, it's making lower lows in this handle. The big euphoria last Thursday was on the judge saying that Ripple was not a security and money flowed into cryptos of all types back then, but selling the news the last 2 days on that. So that's it for the inter-asset correlation. Let's get to the tail of the tape now. Some news, not a lot of news today, but JP Morgan and Goldman Sachs lowered their odds of a recession going into the rest of the year in early 2024. FOMC, the Fed Fund Futures Markets, pricing in a 98% chance of a quarter basis point or a 0.25%, 25 basis point hike when they meet on July 26th. Day count up 5 of the last 6. That's a 30-day rally. Since the breakout, 5th straight day above the 80 EMA, 35th day above the 21 EMA. In range as far as resistance held both on the S&P and the NASDAQ 100, but of course expectations remain positive in this bull market as long as we're trending above the 21-day moving average. Note, I've got highlighted here the average true range of the S&P 500 has now dropped all the way down to 0.84%. This is in sync with what we've been seeing on the VIX, just a decrease in volatility as we trend higher. Huge difference from, down 66+% from how volatile we were at, like 2.5% on a daily basis during the depths of the bear market, as there was so much uncertainty going on. On the upside today, semiconductors, banks, solar's had a big day, and biotech on the downside. Gold and silver stocks recovered some by the close after being weak all day as the dollar drifted off a bit. They improved. Home builders and the like, including retail specific home builders, down today. K-Web, as China had its GDP expectations lowered, and defensive names down on the day. XLPU, VRE, that's staples, utilities, healthcare, and real estate, as well as PIC, which is base metal miners. Some really good performers in the portfolio today. Here's some other stocks that had leading stocks that had very strong days. Only portfolio change we made was adding to our U position, taking our adjusted beta up to 1.8. Bottom line for the day, S&P and NASDAQ hit new recovery highs. Growth leaders continue to run. Let's take a look at individual charts, and then we'll discuss Tesla earnings, risk management. Let's start off with things that we don't own, but we're watching that had good days. Net with a great recovery from this sell-off last week on the supposed news that Microsoft was uh, starting to infringe on the products of some leading security companies. Strong bounce back by that, by net, also by Pan W. You can see the big sell-off. Nobody, absolutely nobody, wanted this stock in the middle of last week, and it's recovered all the losses since then, back up to the 250 level. Palantir, a bunch of the AI software stocks had great days. Palantir up 6%. Datadog, another one of them, up 4%, making new highs on this recovery. ON breaking out of its, confirming the breakout from its cup and handle. Just remember this terrible reaction at its last earnings report. It's now recovered it all a full month before the next earnings report. Upstart, huge move up. It's gone from 30 to 53 now over the last 3.5 weeks, and AEHR continuing on its big earnings breakout last week, tacking on another 6.6%. Standouts in our portfolio today, SMCI, back above the 300 level, up 2.3%. I already Unity, which we added to, bounced nicely off the ADMA, up 3.9%. Let's see, Uber up 1.7%, bouncing off the ADMA. Nvidia, weak week early, strength late, even though a note came out by Goldman expecting this to be one of the big market cap losers in the reshuffling of the NASDAQ 100, but nobody seemed to care about that today, as it got a little ahead of itself on Friday, pulled back, regained half of those losses from Friday, and we'll wrap up with the individual leader in the portfolio today, Tesla, up 3.2%, making new highs with earnings after the close on Wednesday. So, how are we going to manage our earnings risk going in to the earnings report for Tesla? And it's pretty simple. We use a formula. I'll talk about it here, and I'd be glad to share the spreadsheet with anybody that wants it. Just email me, don@revereasset.com. So it starts off with, as a good risk manager, how much are we willing to lose? We don't think about how much we want to gain. We let the market take our positions higher when we're in a bull market. We're constantly looking to the downside. Before we buy anything, we calculate. We don't start counting our chickens. We start counting the potential downside. Where are we going to pull the plug? And the way we size into earnings is we take how much are we willing to lose on a worst case earnings blow up? We've settled on 1% of AUM. So worst case earnings blow up, we're going to lose only 1%, not 1% on the position, but 1% of the total portfolio. So how do we back into that 1%? Well, let's take a look at these first two lines of Tesla. The first one was, this was the beginning of the day, or near the beginning of the day at Tesla. Our position size was 5.65%. The price was at 286. The expected move, we pull this off of Thinkorswim. This is just what the options market is pricing in for the expected move on earnings, and we divide it by price. That gives us a percentage. So the expected move is a 6.38%, either positive or negative. We multiply that by -2 to get what is our worst case going to be to the downside. It's very, very rare that you see more than a 2% move to the downside, but we want to be aggressively conservative. So we're going to say worst case minus two of the expected move, that would be a 12.8% loss. At our current position size, that would be a 0.72 loss to the portfolio. So we're good. We're below the -1. That means we don't have to make any change to the current size that we have in Tesla. In fact, based on this price, the maximum size that we could have is 7.83%. By the end of the day, these numbers change slightly. Tesla, because of the gains on the day, up to 5.75% of the portfolio. Still within tolerance, we're okay. But suppose it got up to 9% of the portfolio, or suppose we were at 9% today by the end of the day. Our max size is 7.84%. These formulas just tell us we need to reduce from 9% to 7.84%, or 1.16% of our current size. That would be a 12.89% reduction in the number of shares that we would have. So we just use this formula. We would reduce the position if we were over the max size, but we're not. A similar example of last quarterly earnings on NVIDIA, we did something very similar. In fact, we do this for all of our holdings, making sure that we don't have too big of a position that would negatively impact the portfolio. Because first of all, our number one job is risk management here. The gains take care of themselves in a bull market. Our job is to manage risk and get the heck out of the way during a bear market, very similar to the way we dodge the majority of the losses in the 2022 bear market, which bottomed at minus 27.5% off the highs. Our loss on the year, less than half of that. So if you're interested in this approach, I'd love to hear from you. You can email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. Right now, we are in growth mode. The market changes, will be in protection mode as always, but for now, we are long until we're proven wrong. And with that, I'm going to wrap up Monday, July 17th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.